Thank you. So thank you very much, Samuel, for giving the floor. And I'm presenting you paper, Digital Currencies in Financial Networks, which is joint work together with colleagues Ilja Kavonius and Michaela Rankan. First, of course, the important caveat: the views expressed in this presentation and this paper are ours only and do not represent the views of the EBA. I'm having a problem of shifting the slides. Hold on, I will probably have to, sorry about that, start again.
Matthias can also help if...
yes, sorry.
You okay, Olli?
Yes, I'm. Is this too small if I keep it like this? Because for this I will definitely be able to shift them.
Just try to pull full screen and then try the arrow keys, or page up, page down.
Okay. Yes. Okay, now it works. Good. Very good. So let's move on. So agenda for the presentation. We have just a motivation background for the paper, very much following the same footsteps than Markus' presentation just before. We discussed a little bit the classification of digital currencies, an important issue for regulatory, economic, monetary policy, statistical, legal, etc. frameworks. Introduction of the model, and then we discussed some results using examples for both central bank digital currencies and private initiatives such as stable coins. And then moving on to conclusions. Okay, I'm still having problems of shifting the slides, unfortunately. Yes, it works now. Hopefully, let's hope it works in the future. So I move on to the third slide directly. So the literature in digital currencies is now expanding very rapidly. We have some important concept papers. First of all, the one Markus was just presenting earlier. We are relying on the earlier version of that paper. Interesting to see it's advanced quite a lot. There are papers from IMF by Tobias Adrian and his colleagues, and also from ECB setting the conceptual scenes for crypto assets and digital currencies. Then there are some papers using static balance sheet examples, very similar than the one slide that Markus was using, shifting the items between the different main sectoral balance sheets of the economy. Papers from Bank of England, again from ECB, and also the Swedish Riksbank. And actually, having seen these papers last year, we realized together with my co-authors that we actually have a paper which we wrote a few years back, which builds a kind of interconnected network of institutional sectors of an economy, which we called macro networks, and uses very similar data than these above mentioned papers. So we decided, let's look how in this framework, this network introduction of digital currencies actually works out. So before going to the model, let's look at a little bit the classification of digital currencies. This is a very important issue, currently a very topical subject among statistical authorities, but also regulators and monetary institutions, including the IMF and OECD as well, who are kind of statistical standard setters very much in this area. So for this paper, the relevant discussions, the treatment in the international national accounts. This discussion is still very much ongoing. So OECD and IMF have working groups working on this area. But the kind of key issues there are currently like whether the crypto assets and digital currencies as a subset of crypto assets should be classified as currency, financial instrument, or investment scheme. And obviously, depending on the characteristics of the particular asset, any one of these three or something else would be a relevant concept to be used. So what is making this complicated is, of course, that there's a very wide variety of crypto assets. There are some very specific small payments system targeted instruments out there. There are large instruments like Bitcoin, but important to notice in Bitcoin is that it's actually no asset at all because there is no issuing entity. So Bitcoin cannot be really placed in the current national accounts framework because it's not issued, it's mined. It's mined like gold or any other precious metal. And the stable coins are facing also a little bit similar problem because it's kind of not easy to classify them as a currency because there are many people and many institutions who consider that the currency should only be something that is issued by the public authority. So one possibility might be in the future that some new subcategories are created under the currency and deposits framework to incorporate stable coins. So in this paper, we follow the latest statements and the latest views of OECD and in the regulatory treatment, the Swiss Financial Market Authority, which at the time of writing this paper was the only one who actually had some pretty crude, though prudential classification available. Now moving on to the model, so this macro network approach that we developed for our earlier paper, actually it constructs a network of balance sheets at the level of institutional sector. So as I said, it's a very similar thing than the one slide showed by Markus in his previous presentation where he moved items between the different balance sheets, assets and liability compositions of different sectors. So here we just simply connect all those balance sheets together. So we construct a network which has as a nodes the institutional sectors. So all the networks have similar node structure. So the nodes are the households, non-financial corporates, the government sector, central bank, the rest of the world sector, commercial banks, and a number of other smaller financial sectors. But the connecting links between these nodes depend on the particular instrument category that we are considering. So we can consider, for example, as instruments deposits or loans or debt securities or equity shares, and we draw a network for each of these instrument categories separately, and they look quite different. And then we can put some shock propagation structures to simulate shocks in this system that follow some algorithmic rules. So in this slide, so we have just two examples of these networks. So we have on the left the network for deposits. So here there are two things to keep in mind at the outset. The first one is that you have these arrows connecting the different institutional sectors. So the arrows are always running from liabilities to the assets. So for example, the MFI sector, which is the banking sector, is a very central node in this deposit network, and it holds a lot of deposit liabilities from households, non-financial corporations, and also from the rest of the world sector. So the second important point for this network on the left is that it is very centralized. So the MFI sector, so the banking sector, is playing a very important role in this network. On the right, you see another network. So this is a network drawn on instrument category debt securities, so bonds issued. So here you see that this network is a lot more decentralized. So there are some important nodes or hubs, as you can call them in the network jargon, but it's still much more balanced than the network of deposits. So in the network of debt securities, you have governments, rest of the world, banking sector, insurance, and investment funds as important nodes, but none of playing such an important role than the banks in the network of deposits. We have a model which is a kind of standard asset liability model, and I should say here at the outset that this is not a general equilibrium framework. We are currently thinking about how to expand this framework in the more behavioral type of system. But for the moment, it is really a framework that allows shock propagation modeling. So we have a standard asset and liability framework for each sector separately. And the idea is then to use incremental shifts in some liability items that move across different sectors. And this is the way we are modeling the introduction of digital currencies in our model. So how do we go about the introduction of digital currencies in our framework? And this is also how we are going to go about with our propagation algorithm. So we have essentially a two-period model or three-period model with time t as 0, including the issuance of digital currency, which can take place by either central bank, in the case of central bank digital currencies. It can be done by investment firm sector if it is a kind of private stablecoin initiative, or it can also come in our network from the rest of the world if it is a global stablecoin that is headquartered outside of the domestic economy. So the period t equals 1, we assume that the shock realization shock here is simply just an ad hoc shift by households and non-financial corporations of part of their deposits out of the commercial banks and moving them into the balance sheet of the sector that is issuing the digital currency. And then the period t equals 2, we consider then different rebalancing strategies, because obviously these shifts out of the commercial banks liability side into the digital currency issuing sector liability side means that there will be funding deficits in the banking sector and the funding surplus in the receiving sector. And we consider several different alternatives for how these particular sectors actually may rebalance their accounts. So, for example, the digital currency issuing sector may rebalance its accounts either by redepositing these funds back to the banking sector. This is essentially what Markus was suggesting in his previous presentation. However, we should mention that there is an important catch in this process, because this would necessarily mean that the banks would be replacing unsecured, cheap deposit funding with secured central bank funding, which is not a kind of one-to-one shift. It has important implications for the bank's funding costs, which needs to be taken into account in this analysis. Or the sector that received additional deposits because it issued the digital currency can use these proceeds to invest in debt security. The banking sector, which faces a funding shortfall now, can either issue debt securities, so replace the deposit funding by wholesale funding. It can rely on the funds redeposited by the sector that issued the digital currency. Or it can do some operations on its asset side. It can sell debt securities to match the assets on the balance sheet with lower liabilities, or it can redeem loans, so it can deleverage, and this obviously has important implications on the non-financial sector. So this is the framework of the model. So I'm just moving now to show you some examples, and I'm focusing here on the case of central bank digital currencies. The case of the global stablecoin is qualitatively similar with some differences, which I can mention briefly en passage here. But starting here from the simple case, where the introduction of the central bank digital currency triggers a deposit shift out of the banking sector, MFI. So first of all, we look at the left network here, which is the status quo network. It's exactly the same network that you saw a couple of slides ago on the left-hand side of the slide. So the status quo network, the relatively centralized network for deposits. In the middle, we see what happens when the firm sector, NFC, and the household sector move deposits out of the MFI to the central bank sector. So there's a reduction of the liabilities of the banking sector towards households and firm sector, and an increase of, or actually an introduction of the liability link from central banks, households and firm sector. So in this case, central bank is now taking directly deposits from the non-financial sector, which is not the case today. So essentially central banks are currently only taking deposits from eligible counterparties who essentially are banks or some other types of financial institutions. So introduction of digital currency changes the nature of the central bank balance sheet in a very profound way. And on the chart on the right, we then show one of the possibilities of rebalancing the accounts, which would be that the central bank would redeposit these funds back to the banking sector. So there will be then a liability link from the banking sector to the central bank. And once again, this would be now secured collateralized funding as opposed to unsecured deposit funding, as was the case in the status quo. Now, looking at some alternative ways of rebalancing. So as we were looking at 2 slides back in the timing chart, there are several alternative ways these sectors can actually go about with rebalancing their balance sheets. We only show the very simple one in the previous slide. Now let's look at the other case where the banking sector decides to sell debt securities from its asset side, from its investment portfolio, in order to match the asset side with the reduced liabilities. And at the same time, the central bank, rather than depositing the proceeds to the commercial banks, it actually increases its bond holding. So it increases the overall size of its balance sheet, matching the asset side with the increased liabilities thanks to the introduction of the digital currency. But both of these sectors do this increase or decrease in the asset side proportionally to the current holdings in the securities portfolios. And other rebalancing rules can easily be implemented. So for example, the banks may want to sell the riskiest bonds first or the most liquid bonds first, but we consider here the easy case where they sell proportionally to the composition of the securities portfolio. Now what happens in this case? So this chart shows that, and this is an important finding of the paper, is that these sectoral compositions of portfolios are quite different. So the bonds that one sector may want to sell are not necessarily the ones that the other sector wants to buy. So for example, in this case, we see the blue bars are showing the bonds that the central bank would be willing to buy to rebalance its portfolio proportionally. And the red bars show the bonds that the banking sector is willing to sell in order to rebalance its portfolio proportionally. So you see that there are, in particular, excess demand on some bonds, in particular this case by bonds issued by the government, but there will be excess supply of some other bonds, in this case those issued by foreign entities and other financial institutions. So there will be winners and losers in this process. So the yields of government bonds would go down and the yields of bank bonds and foreign bonds would go up in this rebalancing process as a result of this particular example.
Hi, Olli, if you could accelerate a bit.
Yes, yes. So I'm moving forward. So I'm jumping over. This is another example which just shows you that there is another, they can construct examples that could be even more drastic in terms of the relative price movements between the individual bonds outstanding. Private initiated global stablecoins, I'm not going to spend more time on these. The only issue is that if you consider global stablecoins, then the rest of the world sector comes into the picture. So the rebalancing issue will then be, of course, dependent on the investment portfolio of the global stablecoin that will probably, in all likelihood, include lots of non-domestic securities as well. But qualitatively, the impacts would be rather similar. There is more analysis that we have done in the paper. So we have been looking, doing these simulations at different shock sizes. So of course, we have completely arbitrarily so far selected the size of deposit shift of 20% of the outstanding deposits. But we can look at this thing, we can relax this assumption and look what happens when the deposit shift approaches 100% of the deposits that households are, for example, keeping in the commercial banks. We can also look at how the network structure changes as the deposit shifts increases in size. And this is an important issue, of course, because as you saw earlier in the slides, the network for deposits in particular is already heavily concentrated on some sectors, and these shifts will have important implications on the structure of this particular network that we discuss much more in detail in the paper. So just the final slide before concluding. So this chart actually is a continuation a little bit of the previous slide, in the way that here we are showing, and here we are looking at completely only on the status quo network. So this is a time series capture of a measure of centrality of the status quo network and how they have evolved over time between 2015 and 2019 over a 5-year period. We have a network centrality measure for the central bank on the left, for the commercial banks in the middle, and for the rest of the world sector on the right. And you can see that over time, so before any introduction of digital currency or even simulation of that, the centrality of the central bank in the network has increased quite dramatically, while the centrality of the commercial banks in the rest of the world have gone down simultaneously. And this is a reflection of the large-scale asset purchase program that the central banks have been involved in during this time period. And obviously, the additional purchases done as a reaction to the COVID crisis come on top of this. So the importance of the central bank in the network, financial network, has already increased quite substantially as a result of the asset purchase program. And this probably serves to show you what the development would be in the case of introduction of digital currency as well. A similar structural shift in these networks is likely to happen. So just as a conclusion of the main findings of the presentation. So there's many different ways of designing different digital currencies. They can be public or private issued currencies, as Markus was discussing. They can be classified as currency, deposit, security, investment fund share. But the way the system is designed has an important implications for the banking sector, for the issuing sector, for the regulator, and the retail users of these instruments. It's also important to keep in mind that the ways the affected parties react and adjust their balance sheet as a result of introduction of these new instruments depends on the design, obviously, but also by the incentives and mandates these particular sectors or investors may face. And also a very important final point is that there are third parties in this system. And given that the financial system is a network, as we have illustrated in this paper, there will be some sectors affected by the introduction of digital currencies and the rebalancing that follows it. The identity of these third parties depends on the design and depends also on the reactions of the immediately affected sectors. But it's important, in our view, to use this kind of simulations analysis to try to ex ante identify the relevant links and who these third parties might be in order to mitigate potential collateral damage. And there are many other details included in the paper, so I invite you to take a look at it if you are interested in issues, but I think I finished here. Ready to take questions. Thank you.
Many thanks, Olli. Now we have as discussant Tim Padkjaer from Danish Central Bank. Tim, I would like to ask if you could do this discussion in 5 minutes, so basically going directly to your main questions to the author. Is it possible?
Yeah, can you see? You can hear me, right?
Yes.
Okay, you can see the slides.
Yes.
Great.
Yes, perfect.
Okay, thanks for giving me the opportunity to discuss this interesting paper and the usual disclaimers apply. I will just I have one slide for just to summarize how I read the paper. I see two main research questions in this paper. One is how to treat digital currencies within the national account framework, and the other one is what happens if consumers and firms make major switches towards digital currencies. What happens to security prices and the financial balance sheets of the different sectors? And then there's two main findings in the paper as I read it. And the first one is that we can actually treat digital currencies within the national account framework, which is actually good news because that's the framework that most macroeconomists work within, and it's also the framework that our macroeconomic models use also for macro-financial stress tests are based on. So and I think it's very useful that we can now think of these currencies within a well-known statistical framework. And the other main conclusion in the paper is that depending on a lot of different unknown assumptions, then there might be some drastic reallocation of assets and liabilities in the financial system. So my overall assessment of this paper is that well, it's very. I can really recommend reading it. It's very easy to read, and I think it's one of the first paper that very systematically show how these currencies move around in the national account framework. The part of the paper where I think that readers are left more, you can say, in the dark is that how should we think about these scenarios? It's very difficult because we don't have any probability distribution. How realistic are these scenarios? And I think to get closer to that, we need to think about why would households and firms switch towards digital currencies? Is it because it's cheaper for them to use them, or do they have better functionalities? And if they have, then why do they have these cost advantages of these currencies, and why do they have better functionalities? And then the crucial question is, why wouldn't traditional banks just start to issue these digital currencies? What's stopping them? And I think that one way to formulate more realistic scenarios would actually be to have a more granular classification of digital currencies within your framework and within the national accounts in general, where you look at the attributes of the digital currencies and also both from a functional perspective and a legal perspective. Regarding the functional perspectives, it's many of the issues that Markus Brunnermeier mentioned, but also something like for instance, you can say is if I should point one of the few things is does it have a stable value in relation to the goods and services that you are buying? I mean, if you have a stable coin that has its assets denominated in the dollar and SDR, then it probably doesn't have a stable value in relation to Danish kroner, which I use for my daily consumption and so on. So there's a lot of different attributes we can look at where the different currencies differ. And the other thing is regarding the legal and regulatory attributes. And one of the key issues here is, are digital currencies, can they offer cheaper services just because they are lighter regulated? Or you can say, will an issuer of a digital currency get a bank stamp, and then it's also moved in the national accounts framework, so it will actually will become a bank, and then the shift is not between different sectors, but it will be between different types of banks. And then we're back to the question: why wouldn't traditional banks just start to issue digital currencies? Is it because there are some monopoly elements related to these digital currencies? For instance, do you have a social network you can benefit from that network knowledge of the network structure that a traditional bank doesn't have? Or are there some technological advances that the issue of digital currencies has that a traditional bank just can't adopt? I think that's what we need to think about if we need to construct more realistic scenarios. So summing up, I think it's a very timely paper. It's a great paper. I think it's great to. I mean, there's a lot of articles about bitcoins that I don't think add much to the table if we need to move forward. I think here we have a systematic source about how we can handle digital currency within the national accounts. And maybe you actually have two papers in your paper. The one half is actually how could we treat digital currencies within the national accounts, and maybe that could be an important input also to the future work on the international statistical manuals. And the other half of the paper, or maybe it's a separate paper, is actually the part that is very important from financial stability is how would further development in this area affect the balance sheets of the different banking institutions. So I think I'll stop here.
Okay, so many thanks. Before start, yes. So before start, yeah, Norris, you can maintain the slides. We also have questions. One from Edward Dusant from Central Bank of Malta. Could the CBDC affect the role of commercial banks in providing deposits to the economy by affecting the interest rate set on the market, for example? And another question from Anna Maria Gresti. Which policy implications for this paper? And Olli, could you please try to summarize in 2-3 minutes maximum?
Thank you. Yes. I'm very conscious about the time. So yes. So yeah. First for Kim's questions about the probability distribution of the scenarios. Yes, of course, they are all completely arbitrary in our paper. So we haven't thought about really that side carefully through. But of course, that would warrant a whole discussion in the paper, and I think it's certainly something that we should include. On the issue of network of why commercial banks would not include their own why the commercial banks would not issue their own digital currencies. Yes, so I think Kim, you answer your own question in a way that the network structure is kind of missing. Partially, that's part of the reason. but also, many of these platforms, they have a ready physically ready payment rails which they can use for implementation of these things. So, for example, Facebook has enormous physical infrastructure which they can leverage directly to use for Libra if they would decide to introduce that. So I think there are many kind of both network structure related issues, but simply physical constraints as well, why small scale digital currencies may not be viable. On the for commercial banks providing deposits in the economy. So the literature, other literature that I have been following is identifying that, of course, introduction of central bank digital currencies would increase competition and would induce banks potentially increase the deposit rates as a reaction. Not sure if that would be the only implication. And on the wider policy implications, I think Markus was covering that very thoroughly in his presentation. So I don't really have much to add to that at this point.
Many thanks, Olli and the authors, and also Kim for a brilliant discussion, also to the participants.